first recurring guest, it's only fitting. I think the first guest as well. I would have a title, but the title is moving here because you're up to so much, accomplishing so much. But many of you people in the industry and space know this guy very well. Thank you for coming back on the show, Sam Silverman. How are you today?
Good, Craig. How's it going?
Everything's great. Excited to see you in about 10 days or so in New York for, a couple weeks stint there for our summit event. And then I'll see you quickly after for your event in Tampa.
Yeah, no, super excited about it.
Yeah, well, let's get right into it. What's the latest with you? A lot's going on. Obviously, I'm on your newsletter. I'm sure a lot of people who listen to this show are also on your newsletter, but what is the latest in the world of you?
So, a few different things, right? If you're going to look at it, I kind of break it out into, two main groups, right? One being the deal side that we're doing in terms of deals we're buying, things we're working on that side of it. And then the second side being more of the agency side, in which we have fully funded, our mastermind community for capital raisers and operators. And then all of these kind of sister agency companies below it to go really support operators, capital raisers, entrepreneurs in their journey to go make things more accessible, both in terms of availability, cost, et cetera, to help make their business and run more smoothly and effectively.
Yeah, well, and that's kind of the one thing that I've really identified with a lot of people is kind of getting things set up. So let's just kind of talk about that and go right into the fully funded side of the conversation, right? So fully funded, for those who don't know, Sam Silverman is the founder of Fully Funded. Within a very quick amount of time, amassed an incredible following and an incredible base, over 100 members now, over 150 maybe, if I'm not mistaken. So let's just kind of get into the services and what you provide. But so Sam's group is for like-minded entrepreneurs looking to raise capital, kind of build their business and really network. So just dive into it. Love to hear kind of the latest there and what's going on and some of the services you're trying to help people provide, because to get your business going, a lot of people want to get in the business. They want to get going, but they don't know where the heck to start, what they need, what they don't need. And it's kind of a what the heck is going on moment for a lot of people. So we'd love for you to kind of unpack all of that.
Yeah, so we started fully funded actually a year ago in September 1st. So we're a few days away from our year mark in doing it. And it's funny, like I'm a big believer when looking at launching a business or a product or a service is go see if you have demand for it before you go build all these things around it. So I think I was telling a friend before I launched, I'm like, hey, we'll go, test pricing out. We'll see if we can go hit a certain number of people in 3 weeks. We'll go launch this. And we hit that number in 36 hours. And it was really cool seeing the demand behind it. And so yeah, we're about a year in. We've built out a ton of stuff in terms of the coaching platform we have, in terms of the community itself of people, in terms of vendor relationships. We're up to about 150 or so members in the last year. And they're all a variety of people, right? We have people like yourself and Rob who are in the community who are seasoned operators who really find value in the ways of how can we go maybe learn a few things in capital raising direct ourselves, but also how can we go connect with people who may be great partners for us to go do deals with in the future, bring capital to our deals, right? Go partner that way. So people kind of on the operator standpoint, looking to go connect with potential fund managers, potential capital partners, loan guarantors, deal finders, etc. We also have the people who are more like myself, who they kind of play the capital allocator type role, who are fund to funds. They may co-sponsor projects based on their involvement, right? They're looking for great partners to go work with. And I'd say lastly, we have folks who are kind of like myself a few years back, right? They may have a great job in sales, or they're a doctor or a lawyer or an accountant or they have some competency that they feel confident that their network, their personality, their skill set could mold into being proficient at operating or raising capital in the future. So for them, they see this as an opportunity to go learn from people who are more experienced, right? Get a level of education and coaching as to how to go start their business, and also have vendors in place in which they may or may not need going forward to actually go make this business a lot more turnkey for them. So we really pride ourselves on bringing diverse people who all take action in some way and want to get better at doing what they're doing. I think each person benefits from each other in a huge way, from the inexperienced, getting to see how the experienced people operate, and the experienced folks maybe finding some great partners in the inexperienced to help move them along in their journey. And in turn, they may want to go partner with them on their deals as well going forward.
Right. So it's kind of a marketplace for kind of like-minded entrepreneurs who maybe are looking for a little more direction or kind of to accelerate their business, which is really cool. So I've noticed that as well, for sure. It's a very dynamic and robust group of people who are in your group, and I'm always impressed to see who's connecting there. And what's going on. So that's always exciting. So let's talk about some of the add-ons and things that you've done. You said services, additions, and we've kind of talked about this before, which is very interesting, which is kind of the a la carte menu approach to how you're kind of transitioning the group to really make it not a one size fits all program, but a above and beyond, tailored for your needs situation. So can you kind of talk about some of the businesses you thought of there, what people have requested, and what you're excited to kind of unroll and launch coming up here?
So when you look at how to go solve things that and make it in like a really simple way, it's you can do two things, right? Look at your expense and see what are you paying the most for yourself. From there, you can go, okay, let's go outsource that first. Let's then try and bring it in house to go solve it for us. And then if we have people asking for us this over and over and over again, rather than affiliating it out, we can have more control over it in terms of better pricing, better offering, better access to offer it, as an in-house service to members of our community. So for example, the first thing we started with, probably the biggest difference in my personal just headspace and time spent in productivity across the variety of businesses that I have today is a virtual assistant, right? I have someone who is manning my inbox at all times. Kim is a saint. And like that probably saves me 15, 20 hours a week of Facebook, LinkedIn conversations of her managing it. And she manages it way more efficiently than I ever would. So that not only frees up time, I feel like she actually converts people better than myself because I just get frustrated doing it, right? It's very tough to be super present there and take the time to go do that. So that's a huge help in terms of weeding out people on my calendar that I shouldn't talk to and prioritizing people that I should. So we brought that in house. We now offer that as a service as well for virtual assistant placement with a focus on capital raisers. In the future, we plan to go branch out in terms of video editing, more administrative type tasks, analyst type roles, right? Cold callers in the future. So looking at all these different avenues in which we can go build out curriculums, right? To help train, onboard, and put virtual assistants through boot camps and go place them with people that need a qualified person to help handle their business for them. Additionally, we've looked at things such as web design, right? Where when you look at the world of capital raising, like I can probably say 2% of capital maybe has come from my website. I think much more so it's something that you need to have to show you're legitimate, but you need a $10,000 website? Probably not, right? Most folks are getting into this space. I think some larger groups are different, right? Unless you're running ads, unless you're really making push behind that. If you're a capital allocator, it's really tough to justify doing ad spend, right? In terms of your ROI on it. Is say you're a capital allocator and you're, run a fund-to-fund program to SPV. Commonly, from what I've seen, you may make 2% upfront of the capital that you raise. So for you to say, hey, I'm going to go spend $1 and get $50 of capital returned in that really quickly period, I wouldn't bet on it, especially right now. So it's really something that the website's great for credibility, but you need something that's, highly optimized and built out to spend $10,000, $15,000 on that. Maybe, but probably not. So we want to be able to go offer economic options to go give our members of our community and others credibility really quickly. And then we're also looking at things such as bookkeeping in the future, right? All these things on our end internally, right? A CRM for capital raisers, that templates built out and such as well. So really looking to go solve for all these things that I've dealt with as personal areas of opportunity to go optimize it and then be potentially able to offer it for better terms to members of our community.
Right. So you've got those items there. Is there anything else looming behind that you're thinking about, incorporating as well if there's demand for it and to maybe offer it, maybe not as abundant as those options?
I think one of the biggest things to go solve for, and we're still looking at how we actually do this logistically, is accounting, right? Anyone in the space knows how important accounting is. I know how much I spend on it every year between myself and the entities that we have, right? So that's the thing we're looking at. There is a little more regulation legislation around the ownership rights as well. Something we're looking into as to how we can go do it in a way that's compliant and legal. So it's something that's definitely on our horizon as to how we go look at it, but nothing that's imminent in terms of how we go structure it. But I view accounting as a huge opportunity in this space as, I'm sure you guys internally, right? You're probably spending multiple mid-six figures in accounting every year. And what I'd say is the bar is set so low for what good is in terms of reliability, in terms of automation systems, in terms of accountability. So what I'd think there's an opportunity in this space for someone to go nail that in the accounting side and it may be us in the future.
That makes sense. That's really awesome. And then, So those are options there. What would you say is the most needed for people that are looking to get into the space, and how would you kind of make it sequential? If I was just thinking from the things you mentioned there, probably start with the website, then VA, then accounting.
Yeah, most likely. Yeah, I definitely think that that's how you look at it. But I'd say it's more important too to understand what you want to go do when you enter the space, right? Do you want to be someone who partners with great groups like Lone Star to go raise capital, right? Be a fund manager, create SPVs to go bring capital to their deals? And do you want to go have other operators work with as well? Or do you want to be someone who buys their own deals of some kind, whether businesses or real estate in some way, and building a team around yourself? And like one's not right or wrong. I think a lot of it just depends on what you want to do for your life, where you're at, how involved you want to be, how much runway you have, how much cash you have in hand, right? The connections you have. So I think first understanding what do you want to go do? And then second is understanding how do you go take those steps to start taking action around it. But I'd say being around people who have been in both seats, you can get a really quick understanding too of what you don't want to go do. I think it's also a really important thing of understanding you can really figure out quickly what you do want to go do by crossing things off the list of what you do not want to go do. Right? The ability to connect with operators or capital allocators and seeing what's their experience been, the good, the bad, the ugly around all of it, I think gives you really good clarity. From there, there's a lot, more clear steps you can go take depending which route it is that you want to go.
Makes sense. So, speaking of which, what are some of the pain points that a lot of people who come to you, maybe not in the group yet, but they of course have the introductionary call? What are the pain points that they're experiencing today? What are they looking to kind of get out of by joining your group, I guess?
So let's kind of start with the operator type persona. I think someone like yourself or Rob looking to go join or kind of at least have a conversation with us. I'd say one, they feel as though right now there's a lot of deal flow, right? We've seen really good deals, especially on a risk-adjusted basis to where they have been in the past to actually get to those realized return numbers, right? Especially in places like multifamily. So for them, they feel as though they have opportunity to either one, learn how to go leverage social media more efficiently, right? Learn how to go build a personal brand, learn how to go run investor calls really efficiently, or they really want to go connect with potential capital partners to help them scale more quickly. Because there are very few groups I've talked to that have a level of scale. I mean, you're buying, 9 figures plus per year. They can go raise all that capital internally themselves from their investor list, right? The more you can raise yourself, the less reliant you become on capital partners, whether it be broker dealers, whether it be fund managers, co-sponsors, whatever it is, right? The less reliant you are on them, the better. But if you want to go scale, you likely need to have them in some way to go support your growth, whether it be volume of deals, the size of deals that you're doing, the confidence to go put down, multiple 6 figures of earnest money into a deal as well to be competitive. So all those things become really important. So I'd say it's the personal branding, the ability to go hunt and find investors himself, profile investors, and then of course the ability of going to network with people who may want to go partner with them now or in the future.
Makes sense.
Alternatively, on the capital allocator standpoint, I think a big thing people want to understand is, again, a lot tied to the personal brand, hunting for investors, building your list, but the systems and process make this business more automated. And also the ability of having, quick references saying, hey, we talked to operator X, who's talked to them, who's worked with them, right? Something that I think we're seeing right now is if you work with people who maybe you wish you didn't have in the past, you could save yourself a lot of angst going forward in terms of experience, right? Because if I'm a capital partner for Lone Star and they give my investors there's two pieces to it, right? A quality experience in terms of updates, communication, that process being really smooth, and they also perform in their deals, right? That makes my life very, very easy. If there's a gap in one of those two areas, it makes your life as a capital partner, because you don't have the control in certain areas, much more difficult. So the ability of saying, hey, who's worked with this group? How are they to work with, right? Or, sharing deals, be able to go team up on deals as well, right? Something we've seen as well in the fund-to-fund economics is there are hard costs to it, right? The PPM can be anywhere between $5,000 and $8,000 up front. You have blue sky filing fees, you have entity formations. So what we've actually seen now is that certain fund managers may partner up to one, reduce those costs, spread out over more capital to make the return profile more similar or better than the operating partner, right? And then the other piece of it is, you may be more apt, right? If Craig, if someone comes to you saying, hey, myself and my two partners, we're going to raise $2 million instead of $800,000, right? What economics can you then give us for doing so? You have more negotiating power. So think of it almost as the ability to go unionize yourself as a fund manager to increase your profitability for both yourself and your fund managers and have more weight in those conversations, right? Like people don't like admitting it, but if you have an investor who's 50 grand versus $2 million, we know who's going to get their call answer more quickly. And it's just the way things go when people scale and grow, right? So like the ability of having that weight helps both in negotiation, reliability, right? All those things there as well.
Yeah. Speaking of fund to fund, by the way, I have no distaste towards anyone who's associated with it, who does it, or who creates the PPMs, this, that. What I dislike is the fact that it's even in play and needs to be done there, because it is such a clunky and a kind of confusing and convoluted process, if you will. I don't know if that's been your experience as well, but I'm not a hater of it. As I said, I understand that you have to do it. I just don't like the process, all the fees associated. What's kind of your take on the fund to fund as well?
Yeah, I wish there were easier ways of doing it, right? But there's certain rules we get and certain guidelines we have to go follow in terms of compliance and regulation that really are non-negotiable, right? So like we view it as more of the tax code, right? Like there are certain things you just have to go do, and they're your rules and they're your guidelines that you can go figure out how to best work within those guidelines. There's certain guidelines you have to go follow. And like I view it as a cost doing business to go be involved in the space, to go take capital from certain folks. So do we wish there were more economical or lesser costs or easier workarounds for it? Sure. But we also really make sure that we are following all those guidelines to be, we're both younger folks as well, like be in this business for a long time. So those are things we're really cognizant of too, is that, yeah, there are rules to it, and we try and go accommodate people the best we can around those to make sure we're still following those guidelines too.
Right. Do you think from a fund to fund perspective, for setting up all that stuff, that will be a kind of a vertical, if you will, that you may think about doing and rolling into your systems as well? Or is it something that's just too variable and too fluid in the sense that you don't really want to touch?
It becomes a question too, and legal is similar to accounting in terms of ownership of companies around that, and also liability, right? Where there's always a risk and reward trade-off around things. So right now, we partner with TribeVest a ton. We've had a great experience with them. They're great guys there and make that process really easy. And handing that piece of the process off for us has been really nice to go do. So we'll see. But I'd say right now it's something we're not considering in the short or medium term. Taking on the liability to do $5,000 to $8,000 PPMs, unless you have massive scale, isn't worth it in my opinion in terms of where I want to spend my personal time. I see a huge value in it, but it's something that for me, like unless you're going all in there and can go really scale and grow and build that technology and systems automation around it, it's tough to get involved there in a way that's super profitable. Unless you're like a one-man shop who's doing, your own SC attorney shop, I think there's a great business there to be had. If you're, one person, I know a few, someone I've worked with in the past who was at a bigger firm, left to go build their own firm around this too, and hopefully making 3, 4, 5 times what they were in their associate role, which is awesome to see for them. But for me personally, it's not something I can go all in on right now, so it's likely a pass.
That makes sense. Yeah, I mean, it's also the other concerning thing as well, which is such a theme to the business and just evolution. These windows open and close quickly. Is what is valid today may not be valid for tomorrow. So it's hard to really anchor into something that may not make sense long term. But it will be obvious that, okay, well, you're going to need a VA indefinitely. And if you find a good one that's worth its weight in gold, and then a website, you're going to need both of those things. No matter what happens to the market, whatever evolution happens, those things will remain constant.
And part of it too is that when you look at, I'm sure we'll touch on this too, like the competitive landscape of agency businesses, is that you have to go figure out what your angle is to go compete. And I think for us, like I still love doing deals. Like I don't my whole life being coaching community. I think there's a huge value in the community, but I also want to be able to go focus on deals. And in turn, I think our pricing reflects that, as we want to be really accessible and cost effective to people, right, who are looking to go into the space. We know that fund managers are taxed heavily in a lot of areas in terms of the pay to play type piece of it. So one of our goals is be able to go offer a comprehensive offering, right? Think a virtual assistant, a website, a CRM, right? Potentially bookkeeping in the future, and a membership to fully funded for less than competitive offerings that we see in the market right now for their 1-year program. So on our end, right, we really want to go focus on being accessible and price competitive and keeping people in the community for a long period of time. Is that we know the bigger the community of quality people have been there for a while, they can offer more value to each other and also to new members coming in too. So I view it as kind of a domino effect and looking at that side of it.
Yeah, I think what you've kind of created, and I think if I'm not mistaken, and please correct me if I'm wrong, there's kind of a one-time cost and fee potentially as well, if I'm not mistaken, that you can partake in. Is that correct?
Yeah, so we have two membership options right now, right? Annual and lifetime. And we'd rather people pay for the lifetime. We make less over the lifetime in people doing it. But we'd rather people who are there for the long term, who feels they got great value, who can be really bought into the community, right? We've seen other big groups do it with a lot of success. And I think the bigger the group grows in terms of scale, the more value that we can go put behind it in terms of spending to go help it grow, in terms of educational resource, in terms of partnerships we can go build, in terms of the biggest thing, like the educational content's great. I think there's information everywhere. Like you can go figure out a lot of stuff that we teach if you want to go spend enough time on YouTube, right? Googling different things, like it's all accessible. But I think the biggest thing that you don't have is the community piece of it and the implementation side of it. So for us, we're focusing a ton on the latter two to go make the information that you can go find yourself. You'll do it a lot quicker with us, but you can go find yourself at a much less price point. We want to go help you implement that and have people around you to go support you in doing so. So you can have that learning curve be much more quickly.
Well, I think it's really genius and that you kind of figured it out. And I don't know how many other groups do this, but it's very hard to get a customer period for a year to sign up to get into your systems. But to offer that, hey, it's not going to blow out your bank. It's not going to blow your back out. It's fine. It's one of those things where you're going to join it and stay there indefinitely because so many people are in these groups. They get kind of 2 years worth of information, and it seems like after the 2 year mark, okay, hey, this is really great, I've learned what I've learned, but I don't really see some of the price being justifiable. But the model of a one-time fee or lower cost makes a lot of sense because then they're in there. It doesn't feel like a sin to kind of put money there. And to your point, with the shift of a lot of people doing the fund to fund process, the conversation I've had with a lot of people who are people I deem to be, folks who are savvy, they're going to be successful in whatever they choose to do. Maybe they're not full-time into real estate, but the cost of doing a fund to fund and raising capital, it's basically a charity the first couple of years you're doing it because you really need, with how fund to fund structure, you need to raise minimum $500,000 for it to actually just be profitable. Now you could raise less than that, but you might be paying or basically breaking even on that endeavor, which is kind of tough for the 4 or 5 year horizon for it to kind of turn around for you to make the money, right? So this is a very expensive thing to do. It's almost a, break even hobby, if you will, to start. And then you hope after 5 years, it really kind of multiplies and compounds on itself. But when you have your pricing fixed, it probably makes everyone feel a lot more comfortable, I have to imagine.
Yeah, it's something as well like I dealt with too, where I started my business. Well, I had a full-time W-2 job. And a lot of people we see come from a similar field to myself, right? That high earning W-2 employee who loves doing deals, loves investing, has a great network of people, feels as though they have the competency to go learn how to go do it. But it's not something that you can go start doing and leave your career tomorrow if you have nothing in savings, right? Because it's a very investor aligned, heavily back weighted type compensation industry where, as someone who's a, fund to fund manager, you may make a small piece up front, but your real money, you may make 4, 5, 6, 8 times that in the back end if the deal performs well and your investor hurdles are reached. So that could be 5 years in the future. I think people getting to space right now are coming in at a great time where the deals being purchased. I mean, we don't know what's happening with the Fed, the election, right? A lot of unknowns, but I'd say looking at where values are today versus where they have been, I think coming into the space, you feel more confident that deals could perform well, right? Because a lot of that is tied to your earnings. The back end of that deal is, does the deal get to a place where certain thresholds are hit, where you're then making money as the fund to fund manager for organizing all of this? So yeah, it's something that you shouldn't plan on having a ton of income from day one unless you have a great book of business you can go to. But it's definitely something more of a long-term career play. So if you're listening to this and you're someone who is a $300,000 a year salesperson, right? Like you have to go raise a lot of money to go make the $300,000 a year in your first few years, which if you can, awesome, go do it. But if you're someone who wants to go test the waters, I definitely recommend building this while you have a W-2 job. Yeah, there's a period of time where it really sucks as you're doing it in terms of the hours you're spending, right? The people you're talking to each day, the W-2 job you're still managing. But once you have that built up, it gives the optionality of leaving in the future where I think longevity is a really big piece of this business.
I couldn't agree more. And let's just take that $300,000 a year salesperson, right? So for you to quit your job comfortably, you'd have to have money coming in enough to cover your overhead, right? But for you to replace $300,000 a year, if that's kind of your nut, right? You want to hit that number, that's good to go for you. Okay. So to hit that, that's basically how we calculate it is we're trying to have our kind of fund managers make somewhere between 10 to 12% on dollars raised on an opportunity on projected numbers. We ideally have our numbers exceed that, but that's kind of the benchmark we look people have hit, right? So for you to basically make $300,000 of upside, through the SPV fund to fund model, that's like raising, call it $3 million to make that 300K. It's doable. Raising $3 million though is not easy, but that's going to come in 5 years. So you want to do that 3 million year over year recurring. So you have to raise a lot of money, but then you will hit critical mass. You will get to the point where it's kind of self-fulfilling and will work itself out, but it does take time to get there. So I just want to remind everyone, hey, as the expression goes, do not quit your day job, right? Or just follow Sam's blueprint going from uber, successful as tech salesperson, invested money, kind of came in and then could eventually phase out of that business to kind of create his own businesses. So there's multiple ways to skin the cat. And I think, the beautiful thing about your business, what you're doing in your day today, what I'm doing is we're all looking to get to the same spot, which is not needing to work, having enough money to come in, but having the optionality to work. Obviously, you're a successful person. You're a producer. You have to work to kind of keep your mind occupied. I would go crazy if I didn't work. But it's the want to have the option to work is what we're all looking to solve for. And that probably goes from, a decade, roughly of really grinding and making it happen and some fortunate tailwinds for you to get to that point, I would say, for most people.
Yeah, and it really just depends on the route that you want to go down in doing it, right? So like having that long-term view of how you go build the business, I think is really important as well. Um, yeah, I mean, just kind of figuring out like what direction you want to go. And like, it's also simple calculation too. When you look at, okay, how much runway do I go have, right? Where if my expenses are X, call it $10,000 a month, right? And I've got 100K in savings and I can go leave and make, $3,000 a month. You're like, okay, my overall cost per month, my net is $7,000. That 100 grand will last me, 13 months, right? 14 months, right? So like figuring out your runway of what that looks like is really important as you look to make the decision, do I go leave my job, right? What volatility will I have? What kind of cushion do I have to do so? So what I'd say is that if you can go build something while you have stability, you can operate from a place of really being rational and not emotional about finances and decision making that way, which gives you a lot more longevity to your career and just helps you align your interests with your investors as well.
Yeah, I actually have a very, interesting question for you, which was what were the paths that you took to kind of get out of the, corporate day to day to be able to your entrepreneur, right? What were some of the investments that you made and was basically just your playbook to get there? And I think a lot of it has to do with debt funds. I'd love for you to kind of talk about debt funds as well for some supplemental income. But just be curious to know if you're willing to share your playbook to kind of get you from, in the matrix, if you will, to out of it.
I got lucky in a lot of ways, right? Like I'm not going to sit here and tell you I made some like excellent decisions. I've definitely handled opportunity well when it was handed to me, but I think a few pieces, right? So one, I got into sales right away. I had no clue what I wanted to do out of school. And sales is a meritocracy in the right organizations where if you perform well, not only can you earn far more than you should, you also get to go move up really quickly and get more responsibility. So I'd say a few things that really helped me. One being the sales side of it, the ability of moving up and earning well and producing in my day job. Two, I built a portfolio of single family homes when I first started investing at like 24 years old, 23 years old. And luckily, when I realized I hated doing that, Zillow was still buying homes. So I sold all those homes to Zillow.
The goal
Below,
Yeah.
correct,
Yeah.
correct. So they were still buying homes. And they were, $250,000 homes or so at exit price, give or take, where I got lucky in the sense that those are all FHA buyers, right? Usually, where any issue, they can't fund the cash to the table, so Zillow is buying them cash, low fees. So did really well on that financially. Had the income from the day job, still lived very modestly at the time in terms of my spend versus my income. right? So you have to go invest pretty heavily. And I'd say lastly, I was at a company in which the stock went from, 17, 18 when I started to 65 when I left. And I took the option of taking a lot of stock options and RSUs in my compensation versus current day cash, which helped give me, some meaningful dollars to go invest with. And I got pretty ballsy early with the investments that I was making, right? Your own money, you can be pretty aggressive if you want to, where if I lose dollar money, my own money I invest, I lost a dollar. Investor capital, different story, reputationally, impact wise, right? But I got pretty aggressive early, invested pretty heavily. So for me to go cover my monthly spend with a low lifestyle in the cash flow I was receiving, right? It gives you a lot of buffer room where if I'm spending a dollar and I'm making 80 cents in cash flow, I don't have to go cover that much of a gap, right? So between that and savings allowed me to go take more risk when looking at starting businesses, right? Leaving a great W-2 job. I think for me, the thing that I knew it was time was when I was just super frustrated in my day job. And in the sales world, right, at least in tech, you're given a quota and your on-track earnings usually ties to your quota. So for example, in one year, you may double your quota and make 3x what you should. In the following year, your quota may double, so you'll make just exactly what you should. So you may produce the same amount and make 2/3 or half as much in a subsequent year when you're like, okay, is this worth it for me to go do this? And can I not be bitter every day going to work? And if those answers aren't both yes, it's likely time that you should go leave, assuming you have enough cushion to go do so.
It's very funny you said that. So I have some friends at Stryker, medical sales, and other companies, and tech companies as well. And they're like, yeah, so if you really crush it, it's a damned if you do, damned if you don't, because you're going to make a lot of money, and then they're going to switch up on you these
You've got a
structures.
window.
Yeah, they're
You've
going
got a
to.
window at each company to make a lot of money. Like your first full year, you can usually do pretty well, right? Your first, like, say you come in, August of a year, you can make okay money that first year. That first, like, 5, 6 months you're there. The next year, make a lot of money. Then from there, your quotas can get jacked up and your earnings likely going to go down substantially at the same output.
And then what they're going to do is after they deem you a producer, your quota gets higher, and they say, hey, this comp structure doesn't work for us. You're going to have to work more, and you're going to make less actually proportionally for your work. Oh, okay, got it. Not fun.
Yeah, it's like being in sports. Think of someone, I'm a big baseball guy, think of someone who's on a, pre-arbitration rookie contract where you're producing way more than you should have for the value that they're giving you. And then once you sign a big deal, the expectations go through the roof and you're viewed a lot more harshly, right? So what I'd say is if find companies that you have that window, right? Things are shifting for some reason. They went through a growth round. And also just find companies you enjoy being at too. Like I've been a part of companies that were growing, been a part of companies that were cutting. The former is a lot more fun to be a part of, but just looking at your longevity, it being in somewhere as well.
Yeah, without a doubt. And honestly, your day to day is very impactful and crucial. When everyone's kind of working towards a bigger goal together, it feels really good. When the company has momentum, it feels really good. When you're not doing so well, it's not fun. And I always think about this all the time on our end with Lone Star, and from time to time, because obviously operations, everyone's kind of going through the mud of it right now. The market's tough, but we're the company right now that gets to acquire new deals. We're not the company that has to raise money for our current deals, doing a capital infusion because we need to do a capital call, something like that. That to me sounds like you're just chain smoking toxicity every single day, as opposed to your point, being at a place that's growing, it's humming, it's exciting, everyone has good energy. That's a wildly different dynamic to kind of show up and do every day. And it's kind of funny. A lot of people have reached out to me asking, oh yeah, I'd love to work with Lone Star, but they're at the shops. I'm like, well, why would you leave your shop? And they give me some nonsense answer. And then I say, all right, so just shoot me straight. Are your deals not performing very well? Because no one leaves a company where they have carry and upside if there's actually carry and upside in the deal, because usually you forfeit that if you leave. And then they finally tell me the truth. Yeah, we're not doing well, and we're about to get foreclosed on or capital call, and the deals are worthless, and my carry's worthless, and I'm kind of jump into the next ship. So it's kind of interesting how that works as well.
I mean, it's the same way too in any big company as well, right? Where it may not be carry in deals, but it may be stock options, right? If you look at a lot of these big companies, the executives, their compensation, the higher you go up, right? Salaries only go so high, right? Then it shifts to you own equity for production in the company. Like look at the Elon package, for example, right? Like that's a great example of if, say you're an executive at a tech company of some kind and you come in, the stock price is X, right? But you have such a leverage on that X where you have the option of, a ton of shares where if things go well, each dollar you move the stock price worth a lot of money to you. So similar where you have a lot of these executives who may be underwater on their options where they have a net zero value. So for them, leaving becomes a lot more digestible. It's also important too, if you're at a company that, has a lot of future upside, whether it be carried interest, whether it be options of some kind, that you keep people there in doing so. You lose control of your employees in terms of handcuffs, right? Golden handcuffs, if those become worthless. Either you have to go renegotiate to go keep good people, or you have to get yourself to a place where you can go perform. Otherwise, top performers won't want to go stay because their compensation may have been cut by half, right? Or by 2/3, whatever it is. And working there becomes a lot less appealing in doing so.
Yeah, without a doubt. Well, you think about the Starbucks package, right? The CEO, formerly of Chipotle, went to Starbucks, and how did theirs comp work? Well, it looks to be like 113 million, or roughly, or over 100 million, right? An absurd number, basically like a baseball contract or an NFL wide receiver contract, right? Nuts. Not an NBA contract; those are too big now. But a contract similar to that. But the interesting caveat is a lot of it is based to and tethered to performance on the stock. Well, you'd rather have stock than just common salary anyways, because stock is converted into, capital gains, long-term capital gains. Well, getting taxed at 20% as opposed to whatever the
We'll
heck the
see.
tax would be otherwise. Yeah, right. We'll see. But hypothetically, if someone is less than $100 million net worth, that is a massive amount of money that they can kind of collect on that if capital gains stay as it is currently. Yeah.
Yeah, I mean, part of it too becomes the tax efficiency of your money and just the aligned incentives, right? Like someone who's taking a 9-figure comp package, they're likely financially stable. Where I think part of it then becomes like it becomes a scoreboard, right? In terms of how well are you doing at your job. And for something like that, like you're at a company that's on the New York Stock Exchange, you can go see your scoreboard every day of how you're performing, which I think is really cool to go see. And I love seeing like the packages that are aligned that way too, similar to operators in the space, right? Where if you look at, for example, your deals, they're typically what, 8 and 70 in terms of structure, give or take,
Mm-hmm.
right? So meaning that for Lone Star's group, after the 8% hit, for them, they want to go outperform that in a big way where that 30% becomes more and more and more valuable to them, right? So like it's aligned in a way that if they make more money, it's great for the investors, it's great for the deals themselves. So it's all pushing towards the same goal, which I think the comp structure, right? Like anyone you interact with, anyone you deal with, understanding how they're measured, compensated, right, viewed is really important in that transaction, in a transaction relationship, and making sure that it all aligns to you as well, right? And the interests are aligned there.
Yeah, if you're just getting feed to death on the front end, but the sponsor doesn't have any carry on the back end, well, good luck. Why would they care to perform? They're just going to milk their fees, and that's kind of that. Also, to your point there about comp and getting looked at, from someone like that, it's also a legacy play. Hey, you want to kind of flex and brag to your friends. Yeah, I solved this, because if you go down and really right the ship like at Starbucks, something like that, you are a legend. You took a name brand, household brand, company people use often multiple times a week, and you're the guy that turned that around. You're an icon at that point from a business perspective. So, there's a lot that into play there. The scoreboard, the ego, and kind of just the story of it itself is, very compelling naturally. Plus, maybe making $1 billion doesn't sound half bad either. Going on to, some of the themes though, I had kind of a thought because you see this so often now. What are some of the themes of the top people that you work with in fully funded, whether it be capital allocators or sponsors?
Yeah, so I definitely break them down into those two types of categories. So I'd say first for the capital allocator, right? They have their group of people they work with. They have diverse investments they offer. I think what we've seen is people who actually offer more different types of investments perform better overall, right? Because if you kind of think about it, right? Say, I'm an investor myself and I'm only working with Craig and Lone Star, right? They're great. They do class multifamily in Texas, right? Quality deals, class B, class A. But I may not want to be so over levered in Texas in that asset class. But if you work with someone who has offerings of you may put 25, 50 cents with them, you may want to also have offerings in a debt fund, for example, which we touched on, right, to provide more cash flow and liquidity. We even have other asset classes, say private equity or mobile home parks or other areas. So I'd say they really have it dialed in as to their portfolio allocation. They also have it really dialed in as to who their investor profile is, and they've nailed that persona. So what I'd say is the more you understand who your end buyer, investor, prospect is, the better you can go align to who they are. Like on my end, I only really raised capital from people who were in tech sales unless they were a connection from someone I knew organically. All my effort, time, content creation was geared towards a certain persona that I knew them inside and out. What time of the month, what time of the quarter I can go reach out to them, right? How to go present things, how they were compensated, right? You know them so well. So I'd say that really separates them, systems process and clear portfolio creation. I'd say on the operator standpoint, it's your experience you give your investors, right? In terms of the support, right? For fund managers as well. So I'd say operator goes in two lenses. One is the retail side. Retail side, I'd say it's the branding you have reputation wise, right? That really helps quite a bit. How you present your deals, right? How you go present yourself. Do people actually want to go work with you? Right. I think that's a huge thing too, is like, do people feel a connection to you and working with you? Track record is always huge. The investor experience, reporting, distributions on time. Alternatively, I think on the how to go attract quality capital partners, right? People who maybe that capital allocator persona who want to go work with an operator, is like, how easy do you make it for them to work with you, right? How does it work in terms of them being able to go get market material, right? Them being able to go have access to you, them being able to go, feel confident they can go position your deals in a big way, whether it be marketing support, legal support, administrative support, right? So I'd say both the experience and accessibility matter in a huge way. And also, what effort you put into attracting certain capital partners too is really important. A lot of people reach out saying, hey, we want to meet capital partners. I'm like, great. What separates you from someone else? Right? Like, what's your plan to get in front of these people? And they think it's something that they come to you, which very rarely is the case. Usually it's you have to go approach them, right? You're the hunter in that sense as well. And they're kind of the person who is being courted, right? And that's a really important dynamic right now in the market too, is how do you go make it so that you can go approach, capital partners in a way that they feel really comfortable to go work with you and trustworthy there as well. And it's a really small space too. So the reputational piece of it of, if someone goes and puts in a chat like our community, hey, who's worked with this group? What the immediate feedback is really important too. So it's a small world, and kind of owning your relationship, owning your branding is huge there too.
Yeah, the deeper I've gotten into this rabbit hole of a business, the more redundant names come up, the same kind of partners. It's all very, very small and tight knit. Interestingly enough, so your name and image, and you're basically your NIL, name, image, likeness, is very crucial. It's kind of going to a sport phrase there. So with that said, as you move forward and transition, what do you want to raise on deals? What gets you excited? I know you've kind of gone into outside of more traditional real estate plays to maybe some other service like businesses or like companies in the PE space, but where are you finding the value, and what do you want to partner on over the next couple of years, would you say?
Yeah, so for me, I see value in a few areas, right? From I think how I allocate my own money is how I position it to investors as well, right? I think the debt fund option right now is great, provides cash flow, liquidity, right? Nothing's ever certain, but I feel most confident that I won't lose money in those deals right now. So I think it's a good place to go park capital until you have somewhere better to go put it. Traditional real estate, I still feel confident in long term. Mobile home parks for depreciation, right? So if you can go qualify as a real estate professional for tax purposes, mobile home parks for depreciation are great. I think multifamily opportunistically has lifetime value as well. And then I think also looking at more of the true private equity space, thinking of rolling up micro cap companies that you can go buy at a lower multiple, right? Put systems, operations, marketing, business plans behind them, and then go sell to more middle market, larger private equity institutions at a larger type play, right? So whether that be businesses or short-term rentals, I think the consolidation play is a really big piece of it for these distillate type industries that are now getting some traction. The boring business model, I think, is still really important. As we've seen it a ton. It's like there's fewer people who do roofs, fewer people who do electrical work, right? Like our generation itself has very little desire to go do those jobs. So the work will be more higher and higher priced. Then we'll see a level of consolidation and systems being put around that. So I think those kind of categories are right now, I think makes a lot of sense. And then we're always looking at and talking to people every day. I probably talk to 30, 40, 50 different operators or capital partners every month from just being involved. Something I love about Fully Funded is I get to talk to interesting people all day long. And you just get to see what makes a lot of sense, what people are working on, and then go see, okay, should I go do more homework on this or not? Right. So I think part of it is getting exposure to a lot there as well. And this could change next year with what happens the next few months in terms of where we view opportunity. But I'd say right now it's the debt fund, so something liquid, right? And for lending capital, I'd say it's the traditional real estate, whether it be multifamily, mobile home park, short-term rentals, and the consolidation play, short-term rentals, service businesses to go take advantage of kind of getting in front of these mid to larger PE type firms.
Makes a lot of sense. Debt has been something I've been fascinated with, and I think it's not everything that I want to put my money into, but it's certainly a subset, a swath of the capital that I want to kind of place there in a bit of time. I think right now, though, we're in a unique period where equity starts to make a lot of sense. And, just from a high level overview for people who don't understand the nuances here of this and are kind of getting into the investment space, debt is a fixed like return. Equity has an immense level of upside, of course, but also you can lose your money. Debt, it's a lot safer in that regard. It's a lower variance. So that's kind of the option there. And people do flock to debt when they're not as confident in the capital market systems, if they still think there's not a market bottom and whatnot. What I personally want to do when the market gets really hot on this next cycle, which I think we're kind of entering in the next one, maybe start parking some of my capital towards debt, making me somewhere between 8 to 12% on my cash, on a cash on cash return, because, hey, you know what? I'd rather make that versus lose money or not have my money be secure, and I'd rather sleep well at night. So there's time and places for all vehicles of investment, in my opinion. Would you kind of second that thought there as well, Sam, or what's kind of your perception on the debt kind of side of things?
I think we'll see the rate of return that you're paid on debt go down over the next while, right? I think there's usually a spread over where interest rates typically are. So do I think we'll keep seeing 8 to 12% in the debt market? Probably not. So I think it'll really be dependent on what the risk-free rate of return becomes and where people feel really confident that. Like the way I view the debt bucket for myself, this is capital that I do not want to go lose, right? I have a lot of capital on my portfolio that I'm willing to go take a level of risk on. This is something that I view as a very fixed return, very low risk, and that could shift in terms of what that rate becomes with where the debt cycle goes to as well.
Makes sense. Yeah, I mean, obviously during the peak ZERP environment, debt was probably paying you approximately nothing or, a very small rate. Now it's a little more attractive. Sam, you've been great. We're almost going to wrap up here. I know you've got a meeting at the top of the hour, as do I. Final thing to speak about, which is, of course, an event that you're hosting here. You're now in the event space. Congratulations. It's a lot of work. But you have your fully funded event coming up in Tampa Bay, if I'm not mistaken. And is it November 7th and 8th? If, give us the details, who should come, why they should come, the whole nine.
Yeah, so you can go see all of it at the fullyfundedsummit.com. November 7th and 8th in Tampa. It's our first event we're doing. So super excited about it. We're keeping it a little bit smaller. We're like capping out about 100, 110 people in total.
Perfect
And
size.
want to make it more intimate, right? Like no sales pitches at all. We're going to, structured networking, some panels, some keynote speakers. All the profits go to a local charity that means a lot to me, right? In terms of helping dogs from kill shelters. So I'm a big supporter of that charity myself personally. So figured we'd take a different spin on the approach to a conference versus more of the traditional route. No sales pitches, no upsells, right? More so the ability to go network with people, whether you're a capital allocator, a deal sponsor, or someone looking to go learn more about the space, right? You want to go learn how to go be in there, or you want to just see, hey, it's something I want to go put time against and see, connect with people in the space already, right? Because I think part of it too is just figuring out what you don't want to go do. And if you have the idea of it, it's a great low cost option to go get in the room, hear from folks, connect with folks as well, and see, do I want to go start putting time, money, effort behind the space as well?
Amazing. What else are you promoting while I have you on here before I let you go? Anything else? Fully funded? How else can people get a hold of you?
Yes, I'm super active on LinkedIn. If you ping me, you'll likely get Kim, who replies to you, but she's awesome at kind of vetting people out and seeing from there. So just send me a note on LinkedIn, super accessible on there as well.
Awesome. Well, Sam, thank you so much for coming on. I'll see you in a couple of days. For all the listeners being here today, we appreciate you, and we'll see you next week. Peace.
Cool. Thanks, Greg.